All right, the last video for chapter 1, we're going to go over 7 common mistakes in technical analysis that almost every trader experiences. Now, I don't know if it's breaking news to you yet, but technical analysis is hard. If you've been trading for at least a little while, or if you've been involved in cryptocurrency, you'll know that making mistakes is part of the game. In fact, losses are almost impossible to avoid for any trader, even the most experienced. Now, with that said, there are some trivial mistakes that almost every beginner makes when starting out. The best traders always remain open-minded, rational, and calm. They understand their game plan, and they simply keep reading what the market is telling them. This is what you also need to do if you want to succeed. If you develop these qualities, you can manage risk, analyze your mistakes, play to your strength, and constantly keep improving. Try to be the calmest person in the room, especially when things are looking rough. Let's see how you can avoid some of these most obvious mistakes. Now, TA is one of the most used ways to analyze financial markets. We spoke in depth about this already. It can be applied to crypto, forex markets, and the gold market, and any other market really that you're looking to trade. And the basic concept of TA, it's relatively easy to grasp. It's a difficult art to master. When you're learning any new skill, it's natural to make a lot of mistakes on the way. This can be especially harmful when it comes to trading and or investing. If you are not careful and you're not learning from your mistakes, you risk losing a significant portion of your capital. Learning from your mistakes is great, but avoiding them as much as possible is much better. Now, this lesson, we're going to talk about some of the most common mistakes in technical analysis. And if you're new to trading, hopefully we can get you to avoid some of these as much as possible. All right. Mistake number 1, not cutting your losses. Let's start with a quote from commodities trader Ed Secatora. Now, the elements of good trading are 1, cutting losses, 2, cutting losses, and 3, you guessed it, cutting losses. If you can follow these 3 rules, you may have a chance at being a successful trader. Now, this seems like a simple step, but it's always good to emphasize its importance. When it comes to trading and investing, protecting your capital should always be your number 1 priority. Starting out with trading can be a daunting undertaking. A solid approach to consider when you're starting out is the following. The first step isn't to win, it's not to lose. This is why it can be favorable to start with smaller position sizing or even risking real funds. I mean, you should be paper trading to prove that you can trade profitably before you start risking your own capital. Now, futures on Binance, for example, they do have a test net. Bybit does have a test net. You can sign up for these easily, and it's the best way to practice. Now, setting a stop loss is a simple rationality. Your trades should have an invalidation point. This is where you either bite the bullet or you let it ride. And I suggest letting it be the point where you bite the bullet and accept your trade idea was wrong. If you don't apply this mindset to your trading, you likely won't be doing it long enough to be able to learn if you can be successful. Even one bad trade can be very detrimental to your portfolio, and you might end up holding a losing bag hoping for the market to recover. Never trade on hope, never trade on emotion, never trade on feelings. Look at the chart. What does the chart tell you? Okay, number 2, and this is extremely important, over trading. Now, when you're an active trader, it's a common mistake to think you always need to be in a trade. Trading involves a lot of analysis and a lot of, sitting around and patiently waiting. With some trading strategies, you may need to wait a long time to get a reliable signal to enter into a trade. Some traders may enter less than 3 trades per year and still produce outstanding returns. Let me say that again. Some traders may enter less than 3 trades per year and still produce outstanding results. Check out this quote from trader Jesse Livermore, one of the pioneers of day trading. He said, "Money is made by sitting, not trading." Try to avoid entering a trade just for the sake of it. I mean, you don't always have to be in a trade. In fact, in some market conditions, it's actually way more profitable to do nothing and wait for an opportunity to present itself. This way you preserve your capital and have it ready to deploy once the good trading opportunities come by again. Now, it's worth keeping in mind that the opportunities will always come back. You just have to wait for them. A similar trading mistake is an overemphasis on lower time frames. We've talked about this, and I'm sure I mentioned it to you in our one-on-one session. You need to spend your time on higher time frames. Analysis done on higher time frames will generally be much more reliable than analysis done on lower time frames. As such, low time frames will produce a lot of market noise and may tempt you to enter trades more often. While there are many successful scalpers and short-term profitable traders, trading on lower time frames usually brings a bad risk to reward ratio. As a risky trading strategy, it's certainly not recommended for beginners. Again, do not need to be in a trade all the time. Number 3, revenge trading. It's quite common to see traders trying to immediately make back a significant loss. This is what we call revenge trading. It doesn't matter if you want to be a technical analyst, a day trader, or a swing trader, avoiding emotional decisions is crucial. It's easy to stay calm when things are going well or even when you make small mistakes. But can you stay calm when things go completely wrong? Can you stick to your trading plan even when everyone else is panicking? Notice the word analysis in this technical analysis. Naturally, notice the word analysis and technical analysis. Now, naturally, this implies an analytical approach to the markets, right? So why would you want to make hasty, emotional decisions in such a framework? If you want to be if you want to be among the best traders, you should be able to stay calm even after the biggest mistakes. Avoid emotional decisions and focus on keeping a logical, analytical mindset. Now, trading immediately after suffering a big loss tends to lead to even more losses. As such, traders may not even trade at all for a period of time following a big loss. This way they can get a fresh start and get back to trading with a clear mind. Very important. Number 4, being too damn stubborn to change your mind. Now, if you'd like to become a successful trader, don't be afraid to change your mind. A lot. Now, market conditions can change really, really quickly. And one thing's a certainty. It's that market conditions are going to change and they will continue to change. Your job as a trader is to recognize those changes and adapt to them. One strategy that works really well in a specific market environment may not work well in another. Now, let's read what legendary trader Paul Tudor Jones had to say about his positions. He said, "Every day I assume every position I have is wrong. It's good to practice to try and take the other side of your arguments to see their potential weaknesses. In this way, your investment thesis and decisions can become more comprehensive." This also brings up another good point. Cognitive biases. Biases can heavily affect your trading decision-making, cloud your judgment, and limit the range of possibilities you are able to consider. Make sure to at least understand the cognitive biases that may affect your trading plans so you can mitigate their consequences more effectively. All right, number 5, ignoring extreme market conditions. Now, there are times when the predictive qualities of TA can become less reliable. These can be black swan events like what we saw in March of 2020, or other kinds of extreme market conditions that are heavily driven by emotion and mass psychology. Ultimately, the markets are driven by supply and demand, and there can be times when they are extremely imbalanced to one side. Take the example of the Relative Strength Index, the RSI, a momentum indicator. Generally, if the reading is below 30, the charted asset may be considered oversold. Does this mean that it's an immediate trade signal when the RSI goes below 30? Absolutely not. It just means that the momentum of the market is currently dictated by the sellers. In other words, it just indicates that sellers are stronger than the buyers. The bears are stronger than the bulls. The RSI can reach extreme levels during extraordinary market conditions. We just saw that. We're actually seeing it right now with Bitcoin. The RSI on the weekly has pinned well above 90 for quite some time now. Now, even with the RSI at extreme levels, it might even drop to single digits. close to the lowest possible reading, even zero, near zero. Even such an extreme oversold reading may not necessarily mean that a reversal is imminent, and the same in reverse. If the RSI is pinned above 90 on the weekly, that doesn't necessarily mean that we are due for a reversal. Okay, so blindly making decisions based on technical tools, reaching extreme readings, can lose you a lot of money. And this is especially true during black swan events, as we mentioned, when the price action can be exceptionally hard to read. And during times like these, the markets can keep going in one direction or another, and no analytical tool will stop them. This is why it's always important to consider other factors as well and not rely on a single tool. All right, number 6, forgetting that technical analysis is a game of probabilities. Now, TA doesn't deal with absolutes. It deals with probabilities. This means that whatever technical approach you're basing your strategies on, there's never a guarantee that the market will behave as you expect. Maybe your analysis suggests that there's a very high probability that the market moving up or down, but that's still not a certainty, right? So it's either 50% here, 60% there, 70% would say in favor of, but there's still a 30% chance it could go against your idea. Now, you need to take this into account when you're setting up your trading strategies. No, it's never a great idea to think that the market will follow your analysis. If you do that, you're prone to oversizing your position and betting too big on one outcome and risking a big financial loss. All right, number 7, and this is very, very important and probably the most important one here. Blindly following other traders. Now, constantly improving your craft is essential if you want to master any skill, right? This is especially true when it comes to trading the financial markets, and in fact, changing market conditions make it a necessity. One of the best ways to learn is to follow experienced technical analysts and traders. However, if you'd like to become consistently good, you also need to find your own strengths and build on them. We can call this your edge, the thing that makes you different from others as a trader. Now, if you read many interviews with successful traders, you'll surely notice that they all have seemingly different strategies. I mean, in fact, one strategy that works perfectly well for one trader may be deemed completely unfeasible by another. There are countless ways to profit off the markets. You just need to find which one suits your personality and trading style the best.